So what happens if your mortgage qualification amount ends up being a lot less than what you feel you can afford? In today's environment with rising interest rates and new stress tests, something we're seeing far more frequently is that young buyers, especially first-time home buyers with smaller deposits, are often going to the bank to get approved for a mortgage, and they're getting approved for an amount that's a lot lower than what that person feels they could afford. If that happens to you, there are a few options that you can consider. But before we get into those options, I just want to stress that before you borrow money, whether it's from a bank or an alternative lender or any other source, it's extremely comfortable to really know your numbers, run your numbers, double, triple check, and make sure that you can comfortably afford not just the payments on the loan that you're going to get, but also the rest of your expenses. You don't want to over leverage yourself. Having said that, if you've run the numbers and you're very confident that you could comfortably afford payments on a loan that is higher than what the bank's willing to lend you as a mortgage, here are three of the most common options you might want to explore. Option one, alternative lenders or private financing. There are a number of smaller companies or even individuals out there who are willing to lend money to buyers for the purchase of a home. The criteria that these smaller companies or individual lenders use is different than the banks, and it's not uncommon that a person may qualify for a larger amount when borrowing from one of these alternative lenders than they would from the bank. Now, these loans typically require minimum of 20% down. They typically come with higher interest rates, and oftentimes the interest on those loans is front loaded. So it's a good short-term solution. It's not necessarily something you'd want to be into for a 20-year term. Option two is gifted funds. You can actually buy a property that's more expensive than what the bank is willing to lend you, provided that you can make up the difference with cash. Now, not everybody has access to a rich uncle or a really good friend who's willing to gift them a bag of money, but if you do, that could be an option for you. So for example, you only qualify for a mortgage of $450,000 and you want to buy a $500,000 property. If you have someone in your life who's willing to gift you the $50,000, you can make that purchase. The bank will still lend you the $450,000. They'll just expect you to make up the difference. Option three, you can get a cosigner. So a cosigner is someone who's going to go on the mortgage with you. Typically, the way this is structured is that you will own 99% of the property. Your cosigner will be on title as someone who owns 1% of the property. Having a cosigner on file protects the bank because that cosigner is liable for the entire mortgage in the event that you default. In other words, you stop paying your mortgage, the bank can go after your cosigner's assets in order to pay the loan back. Cosigner has to be someone who's got good credit. They typically have to have assets, money in the bank, and they usually have to be someone who's working. So in other words, they have to be someone who'd actually qualify for a higher mortgage. Getting a cosigner on your file, your cosigner should understand the risk that they're taking. They should also understand that that could impact their own ability to qualify for loans in the future. So cosigners are a great option for those who have friends and family members who are both willing and able to help. It's the easiest option, and it'll allow you to qualify for a traditional mortgage, usually at the best rates available. However, it should be treated as a short-term option, in my opinion. When I'm working with buyers who are getting cosigners, my advice to them is always to have a plan in place so that when that mortgage is up for renewal, you're able to remove the cosigner from title, remove their risk, and then own 100% of the property. So those are just three of the ways that you can increase your buying power in situations where you don't qualify on your own for as much as you feel you can afford. I hope you enjoy these tips. I'm Serge Papineau. I'm here to help you win. I'd love to know what topic you'd like me to tackle next. Leave me a comment, drop me a line, and I'll see you on the next one.